Hi, everyone. It's Paul Lang back with this week's podcast from Disciplined Trading Strategies. The general topic is what matters in trading and investing. This week, I'm going to be talking about what to trade. First, I want to stop and thank some of you. I have a big following at DTS, at Disciplined Trading Strategies. But since doing these podcasts, I've been hearing from some of you who didn't know me and have just picked me up listening to podcasts and starting to follow and like what I have to say. And actually, I found out that these podcasts are becoming pretty popular. So thanks all for that. I just enjoy doing them. Like I said, I have about 100 topics I can go through before I'm done. I'm on number 15. I try to make these as entertaining as possible, but when you're talking about trading the market and it's an audible thing only, of course, you're missing some of the visual, the charts and that type of stuff. You can always join us over at Disciplined Trading Strategies and enjoy some of the information I have there on the website, as well as attending events. But for the podcast today, I want to talk about what to trade. And remember, I always use the word trade, meaning everything. If you're long-term investing, I just call that long-term trading. So don't think the implication is only day trading. But what do you trade? And what I mean by that is some people trade stocks. You also can call them equities if you want to be fancy. Some people like to trade futures, some trade Forex, some trade crypto, some trade options. What are all these different terms? Which should you trade? What are the pluses and minuses? There are a couple of slide notes that would be helpful there today. And that first one there is just kind of a little breakdown table of some of the pluses and minuses. I do want to run through that for people who are newer and their main concern is, what should I be trading? But toward the end, I want to go into a more detailed discussion about some of the pros and cons, something that some of you may not be aware of, even if you've been trading for a while, and talk about what my favorite is and exactly why. So first of all, if you take a look at that slide, and I did this slide a little while back, it's been posted at Disciplined Trading Strategies. I don't have crypto on there, but it's no big deal. Crypto is just another thing. It's another symbol you put on your screen, and it trades like any other stock, so it's not a big deal. But the others all have some differences to them. So if you look at those columns going across, these are the key things you want to consider when you are going to trade an instrument, meaning any one of these. The liquidity is an issue because you want to make sure that you can purchase the amount that you need to purchase to make your money without having to pay more than you need. That is something that's called slippage. And generally speaking, stocks are the one that you'd be worried about with that. Futures and Forex are extremely liquid. Any normal person could buy all they wanted to exactly at the level and not incur any slippage. Slippage means you're trying to buy a stock, let's say at 22.25, and you want to get 3,000 shares, and you have to pay all the way up to 22.30 because there weren't enough shares available at 22, 25, 26, etc. So a lot of stocks are very liquid. You look at the Fords and BACs of the stock world, and they trade 50 million shares. You could buy all the shares you want at any time. And there's about 300 stocks I keep on my day trading list that are generally you can get all the shares you need. You get beyond the top 300 and spread out to the top 1,000. It depends how many shares you're trading, if they're good for day trading. Naturally, if you're longer term investing or swing trading, that opens the door to a much wider variety of stocks because you don't need as many shares when you're holding longer term. You don't care if there's a little bit of slippage. If you have a $4 stop, 10-cent slippage isn't the same as if you had a 30-cent stop. So liquidity is a big issue. And for that, stocks come in last place, but you can trade the right stocks and make stocks a very liquid issue as well. Hours is a concept for some people. The stock market's only open 6.5 hours. There's some pre and post market trading. Futures and Forex are pretty much 24 hours a day. One advantage some people like for Forex is that the main Forex trading hours are actually when Europe opens. So it's like, 3:30, 4 o'clock our time in the United States. Some people like that because maybe they're working another job or maybe they want to trade the US stock market. So they do that first. For me, it was a big negative because I don't want to get up at 4 in the morning and trade. So the hours may be something that's a factor to you in making a decision what to trade. The next category is variety. And I want to come back and talk about that more a little later. But very simply, it means what kind of different selection do you have to look at? For example, if you're trading futures. Now, I put futures down there, and actually futures covers a lot of things. If you remember the old Trading Places movie with Eddie Murphy, they were trading orange juice futures at the time. There's futures on all the different commodities, but when we say futures these days, people really mean futures on the stock market. That's what's really popular these days. So the ES are the futures for the S&P, the SPY, the NQ are the futures for the QQQ or the NASDAQ 100. So if you're trading the market through futures, The variety is none. You're trading pretty much one entity. That's it. Now, naturally, you could trade other futures, but most people don't do that. If you're trading Forex, there's a half dozen currency pairs that are pretty much it. So you have some variety, but not a lot. This is where stocks has an advantage, where there's a huge variety. Like I just said, there's probably 2,000 stocks most people could be trading. More than that, you could be investing in at least 300, even if you're a fairly large size day trader, you could use. So there's a big variety in stocks, and they all usually have somewhat of a unique pattern. So you got a lot of variety there to look at. Account size needed. Here we're back to a negative for stocks, because stocks, as of I think 2002, has this day trader rule that was imposed by the SEC. And in order to day trade stocks, you need to have a $25,000 account. It's very perfectly regulated by computers. Basically, you can't be day trading. You can, of course, swing trade, hold overnight, hold longer term with any account size you want. But if you want to day trade, meaning buy and sell on the same day, it's extremely restricted to the point you really can't do it. So day traders need to have a $25,000 account. There is a way around that. It's something called the prop trading concept, and you can email me about that if you want more information on that. Here's where futures and Forex become very popular, because there is no minimum account size needed. And generally speaking, whatever the broker open for you, I mean, you can be trading a futures pair with a $5,000 account, Forex similar, very, very leveraged, and no minimum account needed. You'll have to ask the SEC why that silly distinction is there, but it is for some reason. So account size, big pluses for futures and Forex, and that actually is probably one of the biggest draws to futures and Forex. In my opinion, however, it's also one of the biggest negatives. I'll explain that toward the end. Margin, meaning how much buying power do you have? If you are holding overnight, you get 2-to-1 margin. Most people know what that means. It means if you have $5,000, you can buy $10,000 worth of stock. For day trading account, which remember you have to have 25,000, you get 4-to-1 margin. So if you have a $25,000 account, you can buy $100,000 worth of stock, buy it, sell it, in and out all you want all day long. Futures and Forex, the leverage is huge. You can buy a lot with a very small amount of money. That, of course, can work for you, or it, of course, can work against you. And again, this is one of the draws of futures and Forex, because traders can come in with a very small account and participate. And if you know what you're doing, it doesn't sound like a lot of money, but trading one contract of futures, I mean, you can make some decent money during the day doing that if you know what you're doing. The next column, key positive, the key positive thing about that particular instrument. So for stocks, as I mentioned, to me, it's variety. You have a lot of different stocks to look at, all have different charts. For futures and Forex, it's the liquidity and the leverage, and off hours for Forex. Futures, you're trading the market for the most part, so you're the same hours as the stock market. But for Forex, you get that different hours of variety before the US markets typically open. Key negative, well, for stocks, the key negative is if you're day trading stocks, you need a $25,000 account. Not true if you are holding them overnight. Key negative for futures, there's no variety. You're trading one entity, that's the market. And key negative for Forex, a minimal variety. You do have 6 pair that's better than one, but still minimal variety. And the trading hours may be a positive to you, maybe a negative. It depends on exactly where you're coming from. So there's a quick summary for those of you that are a little bit newer about what you might want to be looking at to trade. Remember, hang on at the end. I have some very important comments. But next, let's talk about options. Options are not really a different thing to trade. This is confusing to some people. It's a key point to me. Let me start off by saying this. The dumbest comment I ever hear from traders, well, there's a lot of dumb comments. This is up there as a top 10 stupidest comment, is, oh, I'm not having any luck trading stocks. I'm going to go trade options. Stupid comment. You don't really trade options. Options are not a separate thing. Options are a derivative of something else. If you're trading options on Microsoft, you can't make money with the options unless you know where Microsoft is going. So if you can't make money trading Microsoft, the stock, you're not going to make money trading Microsoft options. All options are really is just a way to shift or to skew the reward to risk. Let me explain that. If you are bullish on Microsoft, you would go long the stock. Naturally, that would take a fair amount of capital to handle overnight, 2-to-1 margin, Microsoft stock price times whatever shares you're taking. That would be a bullish position. And for every tick up that Microsoft goes, you're making some money depending upon how many shares you have. If you wanted to trade Microsoft with options, there are different ways that you could take a bullish position. Most people just think of buying calls, out of the money calls. Those are going for the home run. They're very cheap. They don't cost you much. There's a limited loss because you can only lose whatever you put into the option. And oftentimes people go for very cheap options. And you get a home run if you come out to be right. The problem is that you're almost never right. It's very rare to get a winning trade with out of the money options going for that home run. As a matter of fact, 95, 96% of the out of the money options expire worthless, so the people all lose on those. You could trade at the money options. Now, those are more likely to make some money for you. And the advantage is that you are using less capital. You're buying an option, a call, a kind of a bet, if you will, that the stock is going higher. And when you buy them at the money, at least you have a better chance. If Microsoft stock moves up some, the option will move some also, and you have a better chance of making some money. If you buy deep in the money calls, and you may not be familiar with these terms, but I just want to give you a quick rundown of what you're doing with options. If you buy deep in the money calls, you are coming very close to simulating owning Microsoft the stock. You just get to do it for less capital. So you're saving some money, increasing your return on the account, and kind of coming close to simulating Microsoft, depending upon how deep in the money you go. Deep in the money means if Microsoft is trading at $370 approximately, you would buy calls, let's say, at $320, which would cost you over $50. And they would come very close to simulating the move in Microsoft, up a dollar, but it would cost you a lot less in terms of capital required. But there's other things you can do. Everybody knows pretty much you can buy calls to bet on a stock going higher, but you could also sell puts. Selling puts is a bullish position, but it has a very different reward to risk concept. When you sell puts on Microsoft, you would be putting money in the bank instantly because you're selling something. You're selling a put to somebody else. You get the money in your account immediately. And if Microsoft moves higher, you keep all that money. If Microsoft goes sideways, you keep all that money. So yes, you make money if Microsoft goes nowhere. And Microsoft could even drop a certain amount and you would still keep all of your money. Amazing, right? But if Microsoft takes off and goes much higher, you don't make any more than what you initially got. So you get paid X and you're done, and you hope you get to keep X. If Microsoft drops, however, you could go negative and start incurring an unlimited loss as Microsoft goes lower. So there's that downside. And then there's more complicated options positions where you can take a second option position to cover that downside risk. It's called a spread, but not really the point for now. The point being that it very much changes your reward to risk concept. Selling puts gives you a pretty high batting average because you make your money whether Microsoft goes up, sideways, or sometimes down, but you don't make that much money. And when you have a loss, it can be bigger. And then you get into all the other more complicated ones. You can do bullish put spreads, bullish call spreads, bullish calendar spreads, bullish diagonal spreads, et cetera, et cetera. So you get all these different rewards to risk concepts. But here's the whole thing. You can't make money with Microsoft options unless you have a bias, opinion, a strategy of where Microsoft is going. Now, say the options people are going to tell me, oh, there's delta and neutral strategies, blah, blah, blah. Hey, I know them. You still are going to make money better if you know where the stock's going. And delta neutral costs you a ton of money to adjust all the time if you don't know where the stock's going. And it also takes tons of money to do this. Not the average person is doing that. So options are a nice tool. I like options. I use them sometimes. Doing spreads is a thing to do with options. But to say that I'm going to trade options because I can't figure out where the stock is going is just an insane comment. Similar to me is crypto. Same comment. People say, oh, I'm not having any luck doing futures or stocks. I'm going to start trading crypto. Well, again, total idiot would say that because they're charts. That's all we're looking at is a chart. When I look at a chart, it really doesn't matter if it's a chart of the futures, if it's a chart of Microsoft, if it's a chart of crypto, it doesn't matter. So going to crypto, if you can't make money trading Microsoft, you can't make money trading crypto, period. Now, some people are attracted to crypto because of the volatility. Well, volatility, I don't like when I'm day trading or long-term investing. You can find stocks that give you all the volatility. Matter of fact, almost any stock out there gives you all the volatility you need to make all the money that you want to make. You just have to know how to trade it. And what is helpful is what I call precision. It doesn't help when you're trading something that's so crazy and all over the place that, yeah, maybe you get a big percentage move, but you also have to have a huge percentage as your stop because you don't know where it's going. And maybe you have to try it 3 times because it's so crazy it stops out. Precision is what you should be doing. And you can make great money with precision by building share size. There's nothing wrong with crypto. Crypto is just another thing on the chart. Now, if you say, oh, I like crypto because of what it is, well, now you're not really talking about trading anymore. You're talking about your personal fundamental preference. If you like crypto, go buy some shares, put it away, look at it in 5 years, see how you like it. But that's not really trading. If you want to look at a chart, look at a chart. When you look at a chart, crypto is like anything else. It has a chart pattern we recognize, or it doesn't. You leave it alone if it doesn't. That's all there is to it. If you take a look at slide note number 2, there's just a little summary of what I talked about with the options if you want to look at that for review. And the same thing with slide note number 3, kind of a summary of some of the recent comments I just made. I like that little line at the bottom there. But if you can trade one, you can trade any of them. If you can't trade one, you won't magically be able to trade another. Remember that. You have to learn how to trade a chart, period. What that chart is doesn't matter. Another comment I want to make here along these same lines is that a chart is a chart. It doesn't matter if it's Forex, doesn't matter if it's Microsoft, doesn't matter if it's the futures. A chart is a chart. Yes, one trades in cents, one trades in points, one trades in pips. They have different hours, etc. But reading the chart is exactly the same. Don't ever let anybody tell you that you have to use different time frames on Forex compared to futures, compared to stocks, or different moving averages come into play. That's all garbage. None of that matters. It's all exactly the same. Put a chart in front of you. It doesn't matter what the chart is. You can trade that chart, or you can decide it's not a good pattern to trade, but it doesn't matter what it is. Don't ever be fooled into different courses for different things. It's ridiculous. There is one concept, and that's learning how to read a chart. When you know how to read a chart, it doesn't matter what it is. It also doesn't matter what time frame. 1 minute chart day trading, 5 minute chart day trading, 15-minute chart day trading, daily chart swing trading, weekly chart, longer term, doesn't matter, all the same concepts. There are a couple of little exceptions there because daily charts contain gaps, which is a different topic. But let's get on to my final comments here that I asked you to hold on and wait for. And that is, you go back to slide note number 1, where we have that little graph talking about pluses and minuses. I want to go back to the key positive in there. And stocks key positive is variety. Futures key positive is liquidity. This is a big deal to me. And this is where, yes, anybody can read this slide and say, yeah, I get the difference. But in terms of making money, I have to emphasize to you what a big difference there is here, and why I personally, while what I teach applies to any one of these, what the DTS trading room and long-term ladder focus on is stocks. That's what I like is stocks because of that keyword there, variety. When you learn to trade, what you have to understand is that our job is not to pick up any chart somebody throws at us and then say, okay, here's the trade, long, short, over this, under that, whatever it is. I can't do that. As a matter of fact, if you're a good chart reader, you can't do that, because what we look for are specific patterns that we recognize. And I have this funny thing I say, 97%, but it's not made up. When I scan 1,000 charts a night, I don't even flag 30 of them. And that's less than 3% of the total. And of those, I throw out half of them when I look at them a second time, meaning when I look at 1,000 stocks, there's only 15 that say to me, hey, there's a pattern here that I really get. Now, naturally, for almost any stock I look at, I can make comments about it. I could say, if this, then that. I could say it's bullish, it's bearish, it's in an uptrend, it's in a downtrend. But when you say, hey, tomorrow, can you go trade that and make money? I'd be, no, I don't really want this one because I'm not really sure what to do with it. Now, maybe something could develop tomorrow. I could see if this and this happen. I can always say, if then comments, if it did this, I would short it under that. But just looking at the chart, they're not high odds things. So what we do in trading is we look for specific charts that meet our requirements. And here's the problem with futures. You go to trade the market that day, you don't get the pattern. I'm talking to you right now where we just came off a week where the market was sideways. And sure, you can kind of get the idea. The market made a new high over the high of the last 3 days. You should know to short that. But not many people do, and it's not easy, and there's not a lot of range. When I look at one chart, sometimes I wouldn't want to trade it. I trade the futures sometimes when the market pattern is perfect, but here's the problem. The market pattern is rarely perfect. So being forced to trade futures means you're forced to trade one chart. If you're trading Forex, you're forced to trade 6 charts, and that's all there is. What I love about stocks is next, 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 don't like this chart, don't like this chart. I look at daily charts for longer term. I look at weekly charts for longer term, but for day trading, I look at daily charts. I look at some hourly charts. I look at the gaps in the morning. Between all of these, I pick my favorites. And then I have to see certain things happen. I have to have the chart do something to give me an entry. I have to have the right market timing, the right market bias. All this has to come together. And with stocks, I have that incredible variety. I start out looking at about 1,200 stocks every day. Don't freak out. It only takes me about 20 minutes. And then I end up with watch lists that are maybe 30 stocks. And then I end up with a favorites list that's maybe 5 stocks. And I'm filtering these 5 to 30 stocks on and off the screen, looking for those setups that I want. So I'm down to a very small number, but they're all very high odds things at that point. I think that is critical in trading. I can't emphasize enough. I've been doing this a long time. And to be forced to look at one chart would make it very difficult to make money. Stocks has that variety. Now, people are drawn to futures because you can open an account for $5,000. 97 to 98% of all futures accounts under $5,000 never make money. People just keep putting in more money, putting in more money. Now, maybe that's your plan. Maybe you're learning to trade that way and you consider that a small price to pay. But if you go in untrained, just thinking, oh, I can open an account with futures, but I can't for stocks, you're probably just going to lose money. And if you don't know what you're doing, you're also going to lose confidence and probably give up. So I encourage you to really think about what it is you want to do. I'm not against futures trading. People do it. That's fine. But here's my comment. I am not patient enough to trade one chart of futures. I'm probably more patient than you are. People that know me say, wow, you are really patient. But I'm not patient enough to do that. So it takes a unique person. Some of my students trade futures. My hat's off to them. That's great. I'm not saying you can't. I like futures. I'm just saying it's something you really have to consider. I do stocks because of that variety. Now, it does impose a liability on some people because you have to have a day trading account of $25,000. Again, if you're interested in a prop concept where you'd only need $5,000 to day trade, contact me. My email's at the bottom of one of those slides. It's just paul@disciplinedtradingstrategies.com, PAUL. So I hope all this was some useful information to you, both at a basic level and maybe a little more advanced level. If you have any questions, as always, feel free to email me or stop by the Disciplined Trading Strategies homepage and take a look at what we have to offer there. Until next time, this is Paul for Disciplined Trading Strategies. Good trading, everybody.